everybody. Thank you for joining us for this DD Talks event. I'd like to present to you George Kormas, okay, who is Executive General Manager and Head of Real Estate at Piraeus Bank in Greece. Rafael Coste Campos, Director of Real Estate and Equity Strategy in Bain Capital. Carlos Borja Gonzalez, from a National Director at CBRE. Harry Guillaume, I'm sorry, how do you pronounce that? Harry Ghillemyn, counsel at Goodwin. Goodwin Law Firm, and Guillaume Marinacce from Servihabitat, who is Director of Financial Assets. The first step we'd like to do is a brief introduction from each one of you, telling us a little bit of what you're currently doing, and then we can cover the 3 points that we've decided to discuss today about the real estate market in Europe, which I think is going to be very interesting for our listeners. Me, myself, just a brief introduction. I'm Alejandro Aguirre, and I'm CEO of the BrainsRE platform, which is a big data platform for Southern Europe. So, George, would you like to do a little brief introduction, please?
Good afternoon, everybody. I'm George Kormas. I'm an Executive General Manager of the Piraeus Bank Group, which is the leading banking institution in Greece. I'm a member of the executive committee of the bank, and I'm leading, among other things, the group real estate, managing 4.5 billion of real estate assets.
Thank you very much. Guillaume?
Yes, hi everybody, I'm Guillaume Marinacce. I'm the Executive Director of Financial Assets in Servihabitat. Servihabitat is one of the biggest servicer, real estate and loan servicer in Spain, and we're managing more than 30 billion euros on the market, on the Spanish market. And I joined this company in April 2014, and before I spent 20 years in Goldman Sachs in the servicing company of Goldman Sachs in real estate called Archon Group and the realty management division.
Thank you very much. Carlos, would you brief?
Sure. Hi, Carlos Gonzalez. I'm the head of loan valuation and strategic advisory at CBRE Spain. We are specialized in advising banks in the sale process of NPLs and REOs portfolios, and we also work in the buy side with international investors.
Thank you very much. Rafael?
Good afternoon, everybody. Rafael Coste Campos. I work at Bain Capital, so within the Special Situations Group. I lead a real estate equity strategy vertical with a pan-European mandate focus as of today on value-add, distress, and opportunistic real estate. Our focus has really been more on out-of-favor, complex, or misunderstood situations over time, underinvested, undermanaged properties. And look, in terms of activity, we've deployed about 5 billion over the last years of equity across Europe. And after a quiet 2020, we are currently starting to see quite an interesting pickup in transaction volumes, which we started in Q4 and across Europe, and pretty healthy pipeline at the moment on the distress side that we can touch on during the conversation later on.
Thank you very much. And last but not least, Harry.
Hi, I'm Harry. I'm a restructuring lawyer at Goodwin. I assist many clients on their real estate financings and acquisitions, but equally on the restructuring part. So enforced several security interests over distressed assets, including real estate, and set up various securitization platforms over NPL portfolios in Spain and in Portugal.
Great. Well, thank you all for the brief introduction. As you can see, we're going to cover several countries in Europe with ideas in general. We're going to speak about real estate, specifically distressed opportunities, NPLs, and other options for investment that we're currently touching. The first question that we would like to discuss and mention what your opinions are. The previous crisis led to the development of the European NPL infrastructure. This allowed there to be a market to function. How do you think things are going to be different this time versus the 2008 crisis? Guillaume, for example, we have here.
Well, I mean, that's a little bit, maybe it's a bit, it's a bit soon to know how the things. It's clear that, okay, the two crises are totally different because it's absolutely not the same type of crisis. I mean, I think to 2008 for the one who lived this, it was really was the full system, the bank system was falling down, and so it was another story. I think. Look, I think it's clear that there's going to be with this crisis an adjustment on probably on values and probably on transaction prices. It's clear that I think my opinion is that we're going to see the market changing. I mean, we were more on the market. There was more a market to buy, and now it's going to be more a market to sell, and now it's going to be a market for the buyers. So this is going to change. It's going to take a little bit of time probably because there's always the market needs to wait a little bit of time in order to absorb a little bit this the consequence of the crisis. It's true that we have not seen that much transaction in 2020 last year. There has been some one of the signing deal is one of the Lone Star deal with X, but it's true that there has been a slowdown in the market there. But it's true. What I do think is, look, I mean, in Spain specifically, let's say that we were not totally done with the crisis before the crisis from 2008. There has been a lot of work made for all the developer loans, but in all the things regarding individual loans, mortgage loans, or SMEs, there's not been a lot of transaction. I think the transaction will come. They were supposed to come. They will come anyway, because now with the COVID, I mean, it's clear that the exposure of the bank has increased on all these mortgage loans and all these SMEs. And our estimation is that probably with COVID, there will be in the next 3 years more than 27 to 30 billion of NPL secured on the Spanish bank books, and more than 30 million of unsecured. So it's true that we're going to see things. And I think also probably that the thing will be much faster, because there's kind of at the level of the Europe Commission, especially, there's an action plan that has been discussed and prepared for all the NPLs, because of course what they want is they want to avoid that we are in the same situation than in 2020, 08, 09, where at the end it was very slow to restart. And what we need is really to have bank who finance the economy and finance the real estates, the business for investor or for mortgage. So look, there will be. We're still a bit soon, I would say. It's going to come probably by the end of this year, beginning next year, and with a lot of legal measure to help this transformation.
Thank you. Since you mentioned a little bit the ECB, the impact that the European structure and government is going to have, I'd like to ask George on his opinion. What do you think is going to be different this time versus the 2008 crisis, and how have we set up things already differently? So, George, the audio, please.
Sorry for that. In my opinion, and as we all know, every crisis is a different one. The good thing is that we have learned from the previous crisis, and we do have now a solid background to build the future. What we did learn from the last crisis in place was the fact that we have an infrastructure set up and combined of servicers for non-performing loans, dedicated companies that can do with real estate, and so on. So what we do have now is there's this landscape that it has proved to be the right one if we want to move on with the NPL question. As with regard to the European Central Bank, and we need to take a European approach on that, is that they do make comparisons throughout the Eurozone. As of that, countries that are exceptions or outliers, like Greece was for a long time, as with regard to the question of NPLs, reaching almost 50% of the balance sheet of the national banks. Obviously, outliers need to be managed in a different way, but nevertheless, the ECB or the SSM in particular cannot close its eyes and say, I will have another approach for Greek, Italian, Spanish banks compared to the rest of Europe. That's why there is a very solid and rigid plan for disengagement and NPL reduction in place. This was the case before the COVID-19 crisis, and it continues to be the case even during. There are some postponements, but only partial postponements because of the pandemic. So banks, at least Greek banks, have a strict direction, and this is guidance, and the guidance is reduce your NPL amounts within a very strict timeline. How can you achieve that? Obviously through bulk sales, securitization, maybe through the national guarantee schemes that are in place, like Hercules 1 and 2 in Greece, perhaps through the creation of a national bad bank or a network of bad banks across Europe. This is a highly political question still under discussion, yet some countries do support this way forward. Others are more skeptical in doing so. The most important thing is that we do have sufficient instruments, or allow me the word weapons, that can be used towards the NPL reduction. Why is this so much needed and necessary? It is much needed and necessary because we all know that Europe, as opposed to the US, is mainly driven through banking financing. The economy is driven by the finance provided by banks and not like in the States by capital markets. There are first signs of switch towards this direction, but as we are not there yet, banks need to be relieved from this burden of the past, the NPLs, and they should focus on what they are there, which is to finance the real economy. What needs to be taken care of is to leave aside and stop financing the zombie companies. This was a case that did attract much of the attention in the past because we did experience restructurings of companies that were not viable at the first place. And this is something that even the servicing landscape, the servicers should take good care of. Those are the main changes I would contribute to this first round. And obviously, but with this we can take at a later stage, is the regulation of the landscape for servicers.
Perfect. Great. So no, we'll talk especially about regulation and probably in the next question. Carlos, since you mentioned the possibility of the bad banks, George, Carlos, would you briefly like to mention a little bit the experience in Spain about Sareb, the Spanish bad bank, and how you've seen it help or not in the resolution of the Spanish first crisis and how it can help now?
Sure, thank you. Yeah, well, we were the second bad bank set up in Europe after NAMA, and there were a few other precedents in other regions, such in the US, Canada, or even in some countries in South America. And well, the the creation of Sareb, it was proved as the right solution to clean up the Spanish banking industry balance sheet. I think that since then, the European Union has been more convinced in setting up this type of vehicles across EMEA. Across Europe. Which I don't think that's going to happen is a pan-European bad bank. This is something that has been discussed massively since a long time ago. I've been, my time in London, in some way I was involved in some conversations. Given the big differences across the countries in terms of the legal framework, around the enforcement procedures, and even around the different economic recovery pace, etc. I think it's quite difficult to get even into some kind of network of bad bank across Europe. Although it would be a great idea, but mostly the legal framework is so different, and the enforcement procedures, which makes quite weird for instance, for an international buyer to purchase an international portfolio with exposure in Greece, Spain, France, etc., to go through the workout process. So I'm not very optimistic in that sense. Although I know that it's being discussed right now, but again, I think the case of the example of Sareb is a very good one. The challenge is, as always, how to calculate the transfer price for all the bad assets to be allocated to the new vehicle, and obviously the resulting potential gap between asking and bid prices, right?
Well, thank you very much. Harry, since he's mentioned the different legal frameworks in the different European countries, would you like to mention a little bit, how do you think this time around could be a little bit different based on that?
Yes, it's actually quite difficult in Europe, right? Because there are so many different jurisdictions that do apply different rules. One of the main ways to limit losses that does work, though, is the granting of your financial collateral arrangements, right? Because the opening of insolvency proceedings in whatever member state does not prevent the exercise from rights and rem of creditors. And classically, your share or receivables pledges would still be enforceable over a certain asset. And so what we saw is, and as George said, each crisis is fundamentally different. And this crisis has also really different victims than the previous crisis. In previous crisis in 2012, we mainly restructured banks, lenders, whereas now the sanitary crisis started with actually states coming in and imposing enforcement moratoria, foreclosures, and so on. But also something changed in the documentation. The last 10 years, we really evolved to covenant light deals. So we had a very funny situation where banks, being part of the solution, could not necessarily take contractual remedies or actions under the documents because they were so light, right? And specifically for Spain and Portugal, we had a lot of clients knocking on the door to nevertheless try in their negotiations with their borrowers when they were asked to grant waivers or extensions to grant Luxembourg security packages, which we did, as a single point of enforcement. And we saw a big difference also in asset classes. For instance, offices, the value has been estimated to go a little bit down, but generally the tenants of office space, they continue to pay their rent, right? Because they are less affected by the crisis, because everybody works from home, they are classically financial institutions and so on. So whilst there might be breaches of covenants like LTV ratios, there's generally not a payment default, which is not the case for leisure, hotels, tourism, and so on. where there are payment defaults. And in 2020, we had several clients actually taking control over those assets by an appropriation. And you see the hotels that are being sold now, or the shopping centers that are recently in the press. These lenders have already the ownership, and they market them, and they see, the real estate opportunity. And I'm sure the gentlemen on the call know much better than me where those opportunities exactly lie, but they are being marketed and sold. And obviously the difference between the value as at the date of appropriation and the date when you sell it, this is for the lenders, right? And so this is a technique that we see a lot now, because there is no harmonized legal framework as of yet, and the crisis and the real estate opportunities, they are now. So as very often, the European market has recourse to purely contractual arrangements, either in the finance documents or in security documents, or they set up NPL securitization platforms to either make a gain or to limit the losses.
Great. So
sorry, just to correct one thing that I said. I meant that Sareb was the second largest bad bank. We had previously also UCAR in the UK and some others in Germany. Just to correct.
Perfect. So now we have also the opinion from the buy side. Rafael, Bain has been very active, both previous to this current crisis or from the previous one and this one. I'm going to link it with the next question a little bit. So how do you think the political decisions are affecting the market dynamics? You guys are active in lots of different European countries. Some are more pro-market this time around, some are more pro-regulation. How is this affecting a little bit your decision to invest in one country or in a different country?
Absolutely, Alejandro. I mean, the first thing we're trying to do at Bain is try to really assess what the opportunity set is like going forward. And look, it's hard to quantify it yet. It's early days. But it sounds like consensus talks about like 400 to 500 billion worth of COVID-linked NPLs. So it's not quite the GFC, but very, very meaningful. Now, as some of you have touched on, there are big differences versus the last time around. The first one is real estate. The last time around was actually at the center of the broader crisis. This is obviously different. Now it has consequences on real estate assets. What we're seeing is a lot more impact on obviously retail and hospitality, and I think it will be much more skewed towards those asset classes than others, versus the last time around all asset classes were impacted. And in terms of pace, I think it will be very different, just simply because everyone is in a very different place. Like you look at sponsors like us, we're well capitalized. After the GFC, it was very different. We're all devastated and had other issues with our own portfolio. And so now you have a lot of dry powder sitting and waiting to act. So I expect this to be significantly more competitive. Also much faster to come around. The banks are in a very different place, as George mentioned, versus the last time around. And I think also the infrastructure is in place, right? So there's a lot of acquired knowledge that has been now on the market. In terms of where we're focused at the moment, I think there's a question of how quickly this will come to the market. So, and several of you mentioned this, there was also a lot of still of pre-existing NPLs, right? And those NPLs are still there for us to act on. Those are mostly concentrated in Southern Europe, and that will remain the case. But in terms of new NPLs, and as we've seen in 2008, they tend to come faster in Ireland and the UK. And so, for example, last week there was one of the first processes launched, like in 2021, retail in the UK. So arguably pre-COVID, but COVID didn't help over the last year. And we were seeing quite a lot of also not only NPL portfolios, but like just assets being sold by banks or lenders that just enforced on the asset. So the first three hotel either portfolios or single assets are trading at the moment in the UK. And those were direct consequences of COVID. So I think there will be a big focus on Ireland and the UK initially, simply because it will come faster. But the remaining focus on Southern Europe really, and then I think hospitality will definitely be, simply because if you think about retail and hospitality, one has very obvious headwinds, the other one probably more tailwinds, or at least easier to see the tailwinds. So I suspect there will be a bigger concentration on the latter versus the former.
Great, thank you. So, George, I'm going to ask you, since you lived obviously previous to the crisis as well and have very deep knowledge. What do you think are the lessons learned in Greece at the end? As Rafael was mentioning, some countries, obviously the England, Ireland, the UK, are more market-driven. The solutions they're looking for are faster, while other markets have been a little bit more protectionist. What do you think is a better solution, to go fast and try to solve the problem quickly and recover earlier, or maybe make sure that everything is fully protected and have maybe a longer crisis, but lessen some of the risks that you could receive at the beginning?
The answer is a clear yes. You need to be market driven. There is no way anybody, and if anybody does say so, and is pro-protectionism or similar, I mean, sorry, he or she lives in another world. It's a clear yes towards market solutions at any cost. Obviously, you need to strike and find a golden balance between capital needed in order to disengage from NPLs, because we can all understand that a quick and rapid disengagement means equivalent capital needs. The Greek banking system is now well capitalized and can hold this pressure, and this is the reason you get to see loads of bulk transactions taking place. I mean, us, Piraeus Bank, are engaging in securitizations in the range of 7 billion, 12 billion. Other banks do the same. The answer is market-driven solutions. And it wasn't the case in the past. There were protecting measures in place, not allowing us doing so. But as I said before, there was no infrastructure in place. I mean, there was no servicer landscape. So as of that, you could only do some organic workouts of NPLs within the banks, which were not enough. Obviously not enough if you're having a 50% percentage rate of non-performing loans. Now, and this is a lesson learned or the outcome of the previous crisis, we do have a solid infrastructure and landscape in place. The current government is as well moving along with our European partners along the solution of some further impediments in the process of foreclosure, because the most important thing for somebody who's buying a securitization or a bulk sale is the time to sell, obviously, because, okay, you'll try to work it out, but most of these loans don't have much room for improvement. So you end up wanting to target and get the real estate that is attached in your hands. So up until recently, it was the time to sell was not something we could be proud of because of the juridical system and other impediments in place. Now, only recently, a new insolvency law has been approved by the parliament, which does reduce this time very much. We don't have problems in Greece, like, as I know, in Spain with squads and so on. Obviously, there is a social parameter there. There is a moratorium for social reasons in place, but this has significantly been decreased, the amount that this covers, I mean. So we're talking about a very small perimeter of affected loans or properties in this case. So things, I mean, the legal part is moving on in the right direction. And out-of-court decisions, this is another huge improvement in place. You don't need to wait for a proper court decision that might take a couple of years. There is an out-of-court. There is the possibility to resolve the issue in an out-of-court case. And those are all the positive stuff that we had been experiencing compared to the previous crisis. In one sentence, I would say that Greece is now, I think it's one of the most of the hottest places for buyers of NPL loans. And what needs to be stated here is as well that those loans have not already gone or undergone a repair phase. They have not been dealt with. It's like raw material. So as of that, there is much margin, I would call it this way, for any potential buyer to achieve through their workouts.
Okay, the other side of the coin could be Spain, which probably was the most active market the last time around, and this time is coming slower to the market. Carlos, a little bit from the opinion of what's going to come to the market in Spain, how you think the timing is going to be there, and also Guillaume, as one of the largest asset managers here in Spain, how is your strategy to manage the things, taking into account the regulatory and political status in Spain? If you want first, Carlos, how do you think the pipeline is going to react differently this time in Spain?
Yeah, thank you. Well, first, we are moving in the wrong direction regarding this new regulation around squatters, illegal squatters. And we are, although we have improved the insolvency law in the last years, is not yet the most efficient one, and we're still far away from other countries such as in the UK or Ireland. So we should action those quickly, but unfortunately, I don't think that's not gonna happen. In terms of the banking industry, well, compared to the last crisis, we are well capitalized. I think that the banks have in place the right resources internally to manage the situations, and given the capitalization, it should be easier to go through the disposal process. But now, given this situation where investors, nobody knows where are the real values of the hard assets, right? So this situation is gonna protect the process of deleveraging. When that's gonna when the sales are gonna start depends. I tend to think that something will happen in the second half of the year, but probably we're going to see similar volumes than in 2020, and with more trades completed in the market in 2023. But still, the gap between investors and sellers is huge enough to prevent significant trades in the forthcoming months.
Great. So Guillaume, as an asset manager yourself in Spain, what do you think the impact is having both on the assets that you're managing and also your view of future transactions, both the financial and also of the underlying real estate? What is your opinion on the impact in Spain of the regulation?
Well, on the regulation for the moment, there's we have not seen too much movement in this part in Spain for the moment. Servicing companies are not regulated in Spain, which has some advantages and some inconvenience, but let's say that it has some advantages, I think, more than inconvenience so far. Look, it's true that the market, and we can see already that things are moving a lot on the markets. As I said previously, I think definitely we are going to see a lot of portfolios, probably small to medium in the first stage, of individuals loans and of SMEs. Definitely, this is something that the biggest bank in Spain have on their balance sheets. And with the COVID, I mean, there's clearly an issue there. So probably we need to wait a bit of of provision to come up in order to be able for these banks to either put this on the market or to transfer, as George said, to an entity, a state-owned company that will manage this, a bit like a Servihabitat, so I don't know what. But we're going to have to enter in this period and wait a bit about this provision piece. But for me, it's clear that we're going to have a market around individuals and SMEs in the near future. I think the second thing is we're going to see a lot more of restructuring. That means more portfolio that we're going to need to have product for restructuring the loans, and not just only the NPL workout and just foreclose or try to do a deal, a sale. It's going to be much more around if the people can or cannot repay, and if they can, what can they pay, and how can we organize a new amortization plan for these people. So this is, we have to be ready for this, and this is in individuals like in SMEs for sure, with the companies also. We're going to see also, I think, we spoke about portfolios transfer sales, but there might be also, and we can see this, that a lot of banks in Spain want to outsource the activity. So for a company like Servihabitat, I mean, it's clearly a opportunity there, because I mean there is really a market, and we will see this. This means the bank keeps the book in their balance sheet, but they outsource the management. Okay, in order to have their people and their employees, focusing on the activity of financing the economy. And then I think for Spain specifically, in order to accelerate a little, all that is going to be really the challenge. Going to be, how are we going to be able? How is Spain going to be able to make modification on the legislation? As Carlos said, I mean, there has been, that's true, some improvement around the insolvency law. But I mean, there's not just the problem of the insolvency. There's the problem around the full environment around the debt recovery law, the foreclosure, the system of subasta that is not attracting that much investor, because there could be a market there for investor to go, rather than going on the first market, to go at the market in the foreclosure one and bid on assets. But the system needs to be adjusted here. And I mean, and all that needs to be helped. Probably also all the things around the waivers that you can do to borrowers, because that when you do, especially in SMEs, if you do waivers, I mean, there's tax impact. There can be tax impact. This should be really a global thoughts, a global reflection, in order to see how this country can adapt its legislation to be much faster. Because I really do think that you need to be faster in this kind of crisis, because again, like we said, I mean, in Spain, we are still, we are entering in a new crisis that's going to generate new NPLs, and we are still having the ones that we have since more than 10 years.
Thank you. So since you mentioned these last points are very interesting, the different legal frameworks of the different European countries and the need to go faster this time around. Harry, what things can you mention there of different legal solutions, this idea of different countries with different legal frameworks? We've already mentioned that we don't see a pan-European bad bank as one of the solutions. Where do you see the options coming this time around?
Yeah, actually, I completely agree with Guillaume, and I hear Carlos saying we improved our insolvency law, and George, we have a new insolvency law in Greece. Generally our clients for the bigger ticket acquisitions and financings, they do not want to get involved in reading the dots and commas of new laws, especially if they are not tested yet in front of courts, no? And make investments of several 10 or 100 millions of euros that way. So classically, they would have recourse of putting up their borrowing structure or imposing on the borrower a structure that is in a lender-friendly jurisdiction, used to be the Netherlands, UK, Luxembourg, and the like. Maybe not the UK anymore after Brexit. To ensure that the collateral is there. The reason why in 2020 we didn't see huge amounts of enforcements actually goes back to what Carlos also said. It's very difficult to put a value on the assets for the time being. So normally the right to enforce and to go ahead is not being discussed because this is clear. There are payment defaults or breaches of covenants which are quite well documented, but then nevertheless, you need to put a number on the asset you're appropriating or that you're selling. And it is that number, the value, that will be contested and challenged by the borrower. And we had the chance to read a lot of valuation reports that were heavily caveated or with a lot of qualifications where, the evaluators just said, we think this and that, but we are not sure. And then obviously lenders don't, or direct lending sponsors, they don't take the decision to go ahead because, the risk of litigation around this is just too high. So a lot of our clients, they just decided to kick the can further down the road and restructure. So in that way, I could completely agree and see what Guillaume just actually explained. Yeah.
Great. So I think that leads us to the kind of last point. No, it's also looking at the data that we have in the BrainsRE platform all across Southern Europe. We've seen the prices in Portugal and Spain, which were growing, have stabilized, and in Greece, as George has mentioned in the past, they were still coming out of the crisis, so they had some growth at the end of the year, and Italy has been pretty stable. So even if we're not seeing prices drop yet, it's true that the number of transactions have gone down significantly, but there's still deals to be done. And I think that's where Rafael can tell us a little bit more of where do you think the opportunities are now in Europe in this first stage of this new crisis?
Sure. In terms of prices, you're right, there's very little transactions, so it's very hard to pinpoint what the right level is. I think one way to look at it, and I think it's the only way people have looked at it, at least in 2020, was looking at the public markets and what the public markets were telling us, that how people priced the different assets. And that's how you've seen, if you looked over 2020, logistics and residential were above at the end of 2020 than at the beginning of the year, post-COVID. At the same time, offices were down anywhere between 30 to 40% before the vaccine. Retail was down 60, 70%, depending on the names. So that was the way people thought about it, I think, in 2020. Now, in reality, in the private markets, the problem has been the bid-ask, right? That bid-ask has remained pretty strong. We're seeing that bid-ask closing a bit, which is helpful. At the same time, there remains the issue of the financing, because today, financing is very, very rare, especially for assets that have some complexities or require some asset management, and so that's something that happens less in the US, but given the lending systems and who the lenders are in Europe, still a pretty significant problem. Where I think we will see the opportunity is, look, there's an opportunity across sectors. I think for core capital, though, the market remained pretty strong. We've seen a big dichotomy really between core product and value add product, and core product remains fairly well bid. And if you think about big asset managers, insurance groups, etc., at the end of the day, with 80% of the bonds up 3%, negative rates, there's not that much that they can buy, right? And so real estate has to remain a big chunk of that. But what's interesting is read that gap between value add pricing and core pricing that's wider now than it used to be, at least over the last years, and that will create an opportunity, I think, for us to buy cheaper and aim for higher returns, right? Like we've seen a lot of value add products being priced at core plus or even tighter prices over the last years, and that's hopefully changing again to a bit more spread that actually eventually reflects the risk you're taking on the assets. And more specifically, I think at least for Bain and our opportunistic cost of capital, I think what we'll see a lot of opportunities in hospitality, especially in Southern Europe, because I think the flag penetration on institutional ownership is actually much more present in those countries. At the same time, on the other hand, you have very strong touristic fundamentals that we think will come back. So we think that creates an interesting dynamic in the countries such as Portugal, Spain, Italy, and Greece. Retail will also obviously present an opportunity to pick up assets at a very cheap value. Now, it's hard to figure out what the future of retail is. It will be very asset dependent, some market dependent. And maybe requires change of views simply, but that implies buying very, very cheap, like at land value. So I think those two are the most obvious ones on the value add side. And the last one I think could be interesting too is development, and simply because as natural in every crisis, development supply, the pipeline comes down quite significantly. And but there's demand for grade A product, whether it's residential, whether it's offices or hotels. And I think a lot of the capital doing development the last time around is actually will be on the sidelines, at least for the foreseeable future. And that could also create an opportunity for opportunistic capital to come in and replace natural developers, but with a bigger margin of safety and higher return as expectations.
Great. So I think summing up now, since we have the last 10 minutes, I think it would be very interesting if each one of you can give us one idea or sector, typology, or number or data point that our listeners should track in 2021. Kind of what is the thing that you believe is what we should be looking at during 2021, specifically for the different areas that each one of you are managing, and that could obviously be to interest to all our listeners. George, what do you think we should track to understand the Greek market in real estate for 2021?
Look, in the Greek real estate market, as you already, Alejandro, mentioned, coming out of a 10-year deep crisis, it was on its way to rise. So there is much potential there yet, which is unexploited. We then had we do still have the pandemic in place, but my outlook is extremely positive that things will start evolving with a positive outlook there where it all stopped, and this was March 2020. Asset classes like logistics was on the rise in Greece, as Greece is being considered the entrance of many non-European countries to the European market. So logistics was on the rise. This need is now topped up by the additional needs through the pandemic crisis for large logistics centers or last mile logistics close or in the city centers. Obviously, a star would be logistics, followed by residential being a standard product that is growing along with the GDP growth. Greece is expected to have an extreme high GDP growth in the next years, according to all forecasts, both from Bank of Greece, but from the European Union as well. So Resi will definitely follow this trend. A third would be grade A offices, obviously, as well. And with all these changes that may occur after the pandemic, but nevertheless, it is something to track. I will not propose for investors from abroad to go into the development of plots. Not yet. There is much legislative things that need to be taken care of before somebody enters this field, which has a high potential, but you definitely need a very solid local partner there as well. And I will close this this circle with hotels. Obviously, you all know Greece and the touristic sector being one of the drivers of the Greek economy, suffering at the moment through the pandemic crisis. But a nice Greek island will always remain a nice Greek island, like a Spanish one. Nice island as well will always be a nice one, regardless of what's happening. And we all need, and we all feel the need for extra vacation after this dark year of the pandemic. So with a vaccination passport or similar measures, I do see a rise in the hotel industry, in the touristic industry in general. Obviously, as I have already stated in previous statements, we need to make a separation between the hotel business, running the business, and the real estate part as well. There is no a clear distinction between the two yet in place, but I'm sure that this will soon happen, and professional real estate players will be on their go and come over to Greece. This has already taken place, but we do expect an increase in this direction. Obviously, something to take care of is the so-called silver economy. This is something that recently is one of the focus of the planning of the government for the next years, attracting people to live their latest years in Greece. And there is much of real estate development involved, as this is not set up yet, at least not in the masses that it is needed. And obviously digital nomads, which are something that we expect a very high number in the next years.
Okay.
All in all, those would be an outlook of the Greek real estate market in a sentence.
Very, very interesting. Guillaume, what do you think we should track to understand how both obviously NPLs with real estate collaterals and real estate in Spain is going to evolve this year, 2021?
Yeah. Well, I mean, look, I mean, on my side, I think one thing needs to be really seen and tracked is really how is the financing going to move in the next couple of months. Okay, this is super important because I mean NPLs at the end of the day, it's also what we're doing when we're buying portfolios, whatever the price will be, because for sure the pricing is going to change, and probably as we said, the market's going to be more a market for buyer tomorrow than the buyer for sellers. But what is important is whenever you buy or whenever you manage a non-performing book, the idea is to find solutions. To find solutions with your debtors, DPOs, or I don't know, a debt for asset swap or a restructuring, and for that you need to have banks that finance the products. And so my big concern today is with the movement of the LTVs, specifically with decreases, is what is going to be the impact on the LTV ratio that is changing. What is going to be the impact on the financing, and is pay for a market like Spain is very important because traditionally Spain, the Spanish banks are financing high level of financing on residential. So the question is, do a buyer needs to put more equity, more deposits, or is this going to move? Are they going to finance 70% of the value of a property, or they're going to reduce this thing and this ratio? And this works for individual people that buys assets to live, or the same problem for an office building. Or for a big transaction. So how is the financing going to move, and how is the bank are going to? I think this is really the key thing to to track that is going to be driving also the increase of the transactions.
Perfect. Thank you very much, Carlos. What do you see that we should be tracking in Spain to understand 2021?
Yeah, well, in terms of what Guillaume just said, in terms of financing, the good news is that we are plenty of alternative funds right now here in Spain, thrilling to deploy capital. So they could cover the typical banking financing gap that we suffered in the past. So that should be enough. Obviously, the challenge is what Guillaume said as well, is what's the value, what's the price for a specific asset. But that's a matter of the appraisers, professionals. In terms of we can differentiate between winners and losers after or in the middle of this crisis that we are experiencing in Spain, and I think it's a global trend, as George said. Logistics is the hot spot right now. Even from opportunistic investors, they've been raising funds, value-added funds, to look at those type of assets, and life science, data centers have improved to be very resilient as well. So these have been the most interesting assets to invest in by international investors. And obviously, well, the losers, again, hospitality sector, retail. But the thing is, we don't know at what extent these public cash injections are gonna prevail and are gonna permit those sectors to be alive and not sell all the properties. But and the last one, it's going to be residential. It's heavily dependent on unemployment. Nowadays, I think that we have around 17% of unemployment rate here in Spain, which is not real because of the temporary layoffs. If we go up to 20-25%, residential is going to suffer, like in the last crisis. Obviously, it will depend whether the asset is in Madrid city center, Barcelona, or in secondary areas. But it's something to track on.
Great, thank you very much. Harry, what do you think we should be looking at in 2021?
I'll just keep it very short, and because I hear a lot of distressed opportunities potentially with leverage. If you go down that road, just know that the legal framework has evolved and has been ever more borrower friendly. So if you will do it on the same terms as the covenant-light loans that are in place now, we will have a very interesting conversation for the next crisis, I would say. So be mindful of that, and talk quick enough probably to your special sits teams as well. Way too much we are talking to our clients, and could have been otherwise if the conversation took place a few months before.
Great, thank you. That's something to take into account at this time, is a little bit different. So lastly, Rafael, obviously don't give us away all your strategy, but tell us what you guys are looking at this year.
So I think it will be interesting to track the volumes of real estate in Q1. This will be the first quarter post-vaccine, and that will be very telling in terms of where the capital is going to be deployed. I think you can extrapolate a lot from that and the consequences that come from that. So I'll expect logistics volumes to go up massively, residential, and that will have consequences on cap rates eventually. And so that's something to monitor really, because 2020 was a complicated year. A lot of people just decided to write off the year, but now we'll see what happens and how the investors think about the market. And the other thing to follow closely, I think, are the first prints of specific trades happening. So the UK, you'll see that. We're monitoring this, for example, the new portfolios of hotels coming to the market. It's very interesting to see who is actively chasing them and what the pricing will end up being. So far we've seen that to be super competitive, surprisingly competitive, because we're talking of an asset class that's in the eye of the storm. And for some portfolios, we're talking 20, 25 offers for mediocre assets post-COVID, right? So it's interesting, and that also will tell us what the appetite is of all the big names out there, and that will also drive a lot of the sentiment from investors going forward, but also the pricing. So that's another thing I would track earlier on this year.
Great. Well, I think we've reached the end of the hour. I'd like to thank you all. I think it's been extremely interesting, all the different points of view, both the different countries, different regulatory that we've also discussed, political situation, and then obviously the asset classes and actual opportunities. I'd like to thank you all, and we'll hopefully be able to meet again soon.